Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to talk a little bit about investing, and in particular I'm going to kind of like attack what I consider to be a myth, which is this idea that in order to make higher returns you have to take on higher risk. I'm going to talk about the concept of asymmetric risk reward. What is asymmetric risk reward all about? How do you kind of evaluate it? And how do you use that in order to boost your returns while decreasing your risk at the same time? Okay, so we're going to cover all that. I'm going to give you some examples of investments that might be interesting to you, kind of based on the current climate of market, where it's at, etc. My thoughts, just high level overall. And so if you're interested in that, stick around till the end. If you have not already, please hit the subscribe button, hit the notification bell. Really appreciate our subscribers. We love you guys. They're great. Would appreciate, if you find this interesting, please share it with your friends. And if you're at all interested in how to pay the lowest legal amount of tax possible, how to structure your investments, how to structure your business. Maybe you're interested in moving abroad, you're interested in residencies, citizenship, second passports, you're interested in forming corporate structures, you need to open companies and bank accounts. Reach out to me. You can book a call, cardi.fm/Michael Rosmer, there's a link below, or check out our websites, offshorecitizen.net and offshorecapitalist.com. Okay, let's get into it. All right, so this is a really important concept. It was probably one of the missing pieces in my learning on investing as I kind of went through learning things. And obviously, investing is a never-ending process. It's super, no matter how much you learn, there's always more to learn. But I think it's really important to understand the concept of asymmetric risk reward, even though it's kind of, it's like a catchphrase that lots of people like to throw out there, which is a little bit annoying. The truth is, it's an important thing, right? And so what is this? This is the idea that for every bit of money you're risking, you're making quite a bit more. Okay, so let's talk about examples of where this is bad and examples of where this is done badly versus where this is done well. Okay, so let's say that I'm going to lend money on just a loan to a friend. Okay, and let's say the friend is going to pay me 10%. Okay, so great, I lend money to the friend. Let's just, I don't know, say it's $1,000. Okay, so I lend a friend $1,000. And they say, great, I'm going to pay you 10% interest. Okay, so that means that I'm going to get $100. Now here's the thing. How much money can I make on this? The maximum I can make is $100, right? That's my interest. So on the reward side, my upside is $100. What is my risk? Okay, my risk is $1,000 because that's what I gave them, right? The maximum that I can lose is $1,000. So this is asymmetric in reverse. I have 10 times the risk per unit of reward, okay? I'm risking $1,000 to make $100. Is that a good exchange? That's a terrible exchange, okay? Don't do those deals. Those are bad investments, okay? Now let's turn around and let's look at something that's similar but different. Let's say that I go and I again do a loan, right? But in this case, what I do is I get some collateral, okay? So we could use an example of a friend, sure, why not? And I say, okay, great. I'm willing to lend you $1,000, but I'm going to need some collateral. So your laptop is worth about $1,500. Give me your laptop as collateral, okay? And when you repay me plus the 10% interest, I'll give you your laptop back. If you don't repay me, I'm keeping the laptop, okay? That would be an example. Now, in this case, what is your risk? Well, your risk is you have a laptop, okay? So your risk in that case is, assuming that the laptop's actually worth, say, $1,500, your risk is pretty close to zero, right? Like, you can turn around and you can flip the laptop. Okay, maybe the laptop gets damaged. Maybe, the laptop could be in your house and the house burns down and, stuff. But realistically, you have this collateral. Okay, this is how the banks operate, right? The banks don't usually just lend you huge amounts of money unsecured. They get security. They say, hey, listen, you want a mortgage? Great. If you don't pay us back, we're taking your house. You want a car loan? No problem. We're going to take your car, right? So you're getting some collateral. Now, in this case, so your risk, in this case, we're going to call it zero just for the sake of argument, okay? Because you can't, it's not that you can't lose money, but the risk is very low. Your credit risk might be high, meaning that the chances that they don't repay, that could happen, but the security is going to cover you, okay? On the flip side, how much can you make? Well, you can make $100, okay? Is this a good investment? Well, it's a much better investment than the other one. Now, the thing that I want to point out here is, in this case, did your reward go up? No, your reward is the same, right? Your reward basically is $100. Did your risk go up? No, your risk actually went down, right? So you see how like the whole mindset, like the thing that they tell you in the financial planning industry and the government and the banks, all these guys are idiots, okay? Frankly, they're just idiots. They don't know anything about real investing. They don't do a really good job. That's just the whole like institutional world. I just don't trust governments to teach these things well. I don't like banks are basically rent-seeking organizations, terrible financial planners. Okay, there's a few good financial planners, but 95% of them don't know a thing. They're not good. They're just salespeople, right? So if you're so good, great. Show me your investment returns. This is often the case, okay? Let's look at another example. Right now, we're in the midst of apparently a crypto bull market. Bitcoin, has gone up from earlier in like March 2020 to, present when I'm filming this. It peaked out, we're down a little bit from the all-time high, but the all-time high was around 42,000 or something. Okay, when I buy at 42,000 versus when I bought at, let's call it 40,000 versus 5,000. How much is my risk? Okay. Well, my risk is dramatically lower when I'm buying in at 5,000, when everything's just had this massive sell-off, than when I buy in at 40,000 and things have just run way up. Why? Well, for a few different reasons. First of all, we've kind of seen based on the market over the last few years that there's kind of a floor to how far Bitcoin is seemingly able to drop, okay? Although it, at the very low point, following, basically it peaked in 2017 at around 20,000, then it collapsed down to about 6,000, then, a while later it collapsed down to about 3,000. In the worst case, it kind of collapsed to around 3,000, right? In the worst case, in the collapse of March 2020, it collapsed down to about 4,000, right? And it very quickly recovered, kind of in both of those situations. So what does this tell me? This tells me that likely, the market has decided that that is worth more. Now, could it in theory drop more? Yeah, but, pretty low chance. When you're buying at that level, like I was advocating, and you can go and look at some of the previous videos from kind of like early summer, you're talking about like, it was, $7,000 Bitcoin, right? Well, at $7,000 Bitcoin, let's call it 6,000 just for an easy number, okay? So what's your risk at $6,000 Bitcoin? Seemingly, based on the price history, et cetera, probably 50%, okay? So you could lose, you could have it drop from 6,000 to 3,000. Really, if you're willing to hold over a long period of time, it's unlikely that it's even gonna settle there, that's not gonna recover, but let's just say, okay? So your downside is 50%. Okay, what's your upside? Well, your upside is, you could say it's uncapped. In reality, nothing's really uncapped, right? There's no such thing as like unlimited upside, because there's a limitation on how much money there is in the world. There's a limitation on, how big any market can be. But let's say, it could go to, at the time I was saying like it could easily go 5x, okay? I think I was saying it was 7,000, it could go to 35,000, easily, very conservative numbers. Turns out it's gone way past that, right? So let's just say that within a 12-month period, so from that time, let's say that was, June. So from June until June the next year, it could go 10x, okay? So what are you risking then? You're risking $3,000 to possibly make, $60,000 less your initial investment, right? Is that asymmetric risk reward? Yeah, that's a very good risk reward. Fantastic, right? Like it's pretty decent. Now let's compare it to some other investments. Let's go and look at something like Tesla, okay? Tesla's all the rage right now. I think their market cap, last time I checked, was like, oh boy, let's call it $800 billion, okay? I think it was 838 billion or something. Let's just call it 800 billion. Okay, so it just ran up from like, 100 billion or something to 800 billion in the course of less than a year, or around a year, okay? So like, okay, well, where does that put us? Okay, well, how far can it drop? Well, you can start to kind of look at this and you can say, well, they have a certain amount of fixed assets, right? They certainly sell a certain number of cars, they make a certain amount of profit, they have a certain market share, etc. So there are some metrics that we can use to evaluate how far down it can drop. I would say, reasonably speaking, barring some extreme things, because of course, in theory, it's a company, it could get mismanaged, it could go bankrupt, Elon Musk could die, lots of things could happen that could, be kind of like extreme events that could take it out. But let's pull out the extreme events and look at, the more likely events. How far could it drop down? Maybe it could drop down to somewhere like the $20 to $40 billion range. Where do I come up with that number? I come up with that number by comparing it to other car companies, okay? So if you compare it to Ford, you're around, Ford's probably, I don't know what it's trading at right now, but maybe like a $50 billion market cap, something like that, maybe $40 billion market cap, somewhere in that range, same thing GM, these things. So let's say that Tesla can fall to, maximum downside is $40 billion, okay? So that's a downside of 95%, right? That's like really bad. Let's say that, you're like, okay, well, I'm more confident in the company than that, et cetera. I'm going to give it the benefit of I'm going to say $80 billion, okay? It couldn't drop more than to below $80 billion. Okay, that's a 90% loss, right? On the flip side, how much can Tesla go up? I had a friend tell me a couple days ago that he figures it can go 4x from here. 4x from here would put it at $3.2 trillion, okay? Now let's recognize the biggest company in the world, which makes an enormous amount of profit, Apple, or comparable, Microsoft, et cetera, they peaked their market caps at around 2 trillion. We've never had companies bigger than that in the history of the world, okay? So is it really reasonable that Tesla, which, look, never bet against Elon, Elon's amazing, et cetera, but the reality is just like, can it go up 4x in any reasonable period of time? Like, okay, yeah, maybe over 40 years or something, but is it reasonable to think that it can go 4x from here? No, it's not. It's just not reasonable because look, like it's already, the whole car industry, okay? The entire car industry is worth dramatically less than Tesla is worth today, okay? Now you can say, well, it's not really about just a car company, it's a battery company, it's about power, things like this. Okay, like all of that aside, the point is that sales have to come from somewhere. There's only so much stuff that is sold and there's only so much profit is there. And you can start to add up. Like some people will say, okay, great. Like, well, they're going into the insurance business. Okay, great. What's the insurance industry worth? Like, let's go and add that up. Let's figure it out, right? So the upside of Tesla, maybe in an extreme environment, let's call it, double. Okay, it's like $1.6 trillion. I honestly don't think that that's very reasonable. It's not impossible because markets are insane, right? People can do all kinds of irrational things, but just for what Tesla is, the price is way ahead of the fundamentals at this point in time, okay? So I would argue that you are risking like an 80% loss. Let's be more conservative. Let's say that it's, we're gonna call it $160 billion, right? So you're like, okay, great, I'm not risking an 80% loss, I'm risking 60% loss, right? Is that right? 60%? Something like that. No, sorry. That would be an 80% loss. So I'm risking an 80% loss, right? That it could drop to 160 billion with doubling my money. Okay, is that very good risk to reward? I would typically say no. Like that's not a bet that I would make. You can factor probabilities and things like that into there. But the bottom line is that when you're talking about that, I typically say if I have a chance of a 50% loss, then I want a chance of doubling my money. Okay, I have to have at least that ratio. Okay. And the reason is, if I take a 50% loss to recover, I need to double my money to get back to that same point. Okay, so if I take an 80% loss, I need to do a 5x to get back to that same point. If I take a 90% loss, I need a 10x to get back to that same point. So hence, if I'm going to risk 90%, I better have a 20x upside, that kind of thing, right? So that's kind of in my head how I would make that delineation. You can do it yourself, however you want. But the more important thing to note here is just there's only so far things can go up, and there's only so far things can go down. And what you want to do, the whole point of asymmetric risk to reward, is you want the multiples of how much it can go up to be dramatically more than how much can be lost, okay? And what that allows, why this is so important, is you're going to be wrong a lot of the times in investing, okay? Nobody gets it right all the time. When somebody comes and asks you what it is, it's like your crystal ball is broken, my crystal ball is broken. We don't have a clue. We can kind of make some educated guesses, but anything could happen, right? Not anything, but pretty broad. So what we want to do to protect ourselves from that is we want to find asymmetric risk to reward bets where we can bet like our downside is a small multiple compared to the upside. It's okay that you could have a chance of 100% loss if your upside is high enough. Because what that means is you can afford to make the bet over and over again, right? That's really what you're looking at. You're saying, hey, listen, I can make this bet and I can go and I can do it. If I lose, I can do it again. And I lose, I can do it again. And I can do it enough times over that, you know, eventually I'm likely to be right, and I'm going to work on improving my likelihood, right? Ideally, you do some things to control your downside. Anyway, that's the basic concept. I hope it made sense how I articulated it here. I think it's a really important topic for people to understand when they're investing, whether you're investing internationally or domestically, whether it's stocks or, you know, private loans or mortgages or doing real estate, doing crypto, etc. Asymmetric risk to reward. If you liked the video, please tell me in the comments, give me a thumbs up. If you didn't, please tell me in the comments. Please don't give it a thumbs down. If you found it useful, share it with your friends, click the subscribe button, click the notification bell. And as I said, if you're interested at all in international tax planning, how to reduce your taxes as most legally possible, if you're interested in second passports, citizenships, residencies, how to set up international structures, help setting up international structures, reach out to us. You can book a call with me, clarity.fm/Michael Rosmer. There's a link below. And I will see you guys on the next video.